It's a mixed picture from whichever Asian markets are currently open this morning.
The 20-day moving average at 25,500 is the important downside level for the Nifty.
Their consolidated revenue will decline in mid-single digit.
First measure that has been announced is limiting weekly expiries to one benchmark per exchange.
One factor that might even affect the markets even more is the intraday monitoring of positions.
Monday down sharply, Tuesday up sharply, and today it's down sharply once again.
Try to be 50, but we should be comfortably at around 48, should be comfortable.
That 1/3 of global crude oil production comes in from Middle East, and this is the area that the markets are keeping a keen eye on.
A 300-point cut on the Nifty. We saw a recovery, but again, that is sold into, and we are at the day's low right now.
We've grown almost 30% year on year. It's been a great growth story for us.
Definitely, at this point in time, we have the markets which are under pressure as the Middle East conflict has deepened.
So quite a lot of correction is seen both in the front line and even the broader end of the markets.
Sharpest strategies, top market trends, unmatched perspectives, the trading day's most comprehensive roundup. Stay ahead with NSE Closing Bell, broadcasting live from the CNBC-TV18 Motilal Oswal studios in Mumbai.
Well, that is the day so far, and what a day we've been having on the downside. And, lower and lower levels pushing down as we speak, hour after hour. So we're down 500 points now. We're starting Closing Bell half an hour early to provide you all of the perspective, both local and global, and we'll do that. I'm Prashant. With me, my colleagues Surabhi and Rima, and of course, Nigel is joining us from the newsroom floor. Guys, hi, good afternoon.
Hi, afternoon. There's absolutely been no respite for the markets, for the bulls. And the second half could also be shaky because frontline European indices have opened with a cut of about 1%, 1.1% lower on the CAC, and the DAX too is reeling with a cut of about 0.9%. So not looking good on the Western shores.
Yeah, and also the futures. I mean, Wall Street futures are down by about 0.5% as we speak. So let's say I think tomorrow is also the non-farm payrolls data, and then we were not trading while the rest of the world was grappling with a lot of these, Middle East developments. So I think all things put together, it's turned out to be a heady cocktail for the bulls.
By the way, today's FII selling number will again be interesting. Somebody was talking to saying that it's going to be very large volume of selling. So the talking point, of course, and I think it is true, and I think we've been discussing this. Does China doing well mean that money flows out of emerging markets like India? We've kind of got all kinds of views, right? But I think it's undeniable now that because the rally has been so furious and so sudden, and it kind of has, I think, gotten so many people straight away into the FOMO bucket, that maybe there is some rotation, at least in the near term, which is happening. We had Ben Powell of BlackRock with us in the morning, who was making the same point, that maybe in the very short term that is true. Although, the larger point that when EMs do well, everybody gets money. But I think that is for maybe a week down, 2 weeks down. But for now, that shock is underway. By the way, China mainland markets are shut all of this week. Hang Seng is trading, and that is a China proxy. But Hang Seng also at one point during the day was down 5%. I think it closed down about 1.6, 1.7% or so. So that's the sort of quick picture on your screen now. So again, understandable, healthy pause, consolidation, what you want to call, because of the very sharp moves that we've had. Let's welcome in Adrian Mowat, who's with us. Needs no introduction, veteran investor in emerging markets. Adrian, great to have you with us here on the program. Thanks for your time. We're not used to 2% down days. We've got one today. What's the big driver, in your opinion?
There are two things, and you already talked about some of these in the introduction. At the market fundamental level, we probably got ahead of ourselves in terms of US interest rate cut expectations, particularly as expressed in 10-year bond yields moving as low as 3.7%. The ADP report indicates that perhaps the non-farm payroll that will come out tomorrow morning US time will show a more robust number than we've seen in some of the more recent prints, perhaps something around 150,000. So remember about the context of this is that the economic bears are looking for the increase in the non-farm payroll to continue to narrow as indication of the economy slowing meaningfully. if the decline in the non-farm payroll increases, which is still quite high at 150, stays at this level, then that narrative looks weaker. So the interest rate cutting support for the market may be more modest than the market was expecting a week or so ago. Clearly, situations in the Middle East are escalating. You know, you've had the President of the United States having to make a statement about whether the US would approve Israel attacking Iran's nuclear facilities. You know, so I think just indicative of how rapidly this situation is escalating. We're seeing some impact in the oil markets as well. So we're seeing markets selling off after what has actually been a pretty decent September. Now, within emerging markets, as the gentleman from BlackRock, Ben, was indicating, you know, we have got this rotation story where Chinese markets have stood on their tails and are moving up so rapidly that active fund managers who've been underweight China, overweight India, need to address that position. And it is worth highlighting that the Chinese equities that they're buying into are still very inexpensive despite the moves that we've had. And the level of policy support does look very significant. I think it is on par to Mario Draghi when he was heading the ECB, coming out of the GFC into the Euro crisis, indicating he'll do whatever it takes. And in doing whatever it takes, first thing you need to do is inflate the value of financial assets, so both equities and bond markets. That's very important at improving the collateral within the financial system, which takes some of the stress out of the balance sheet recession that's been building in China. So you can overthink this and think, oh, is this really going to fix the economic problems? Don't look at it that way. Look at it as the medicine is going to be good for the stock market. We can answer the economic story a little bit further on. So short term, I think India is under particular pressure because it's been a terrific market, a long-term bull market, big outperformer, positioning is bullish there with foreign investors. They need to sell some of that to buy some in China in order to reduce their underweight, reduce the pain that they're experiencing in underperforming a rallying China.
Adrian, hi. Thank you for joining in. You've laid out the various moving parts that impact the global markets and macros very beautifully, whether it's, you know, what happens in terms of Fed rate cuts, the Middle East conflict. But the question is, how does one price in the Middle East conflict? Because there are huge implications for markets like India, the way crude behaves. So when you look at the short to medium term, you spoke about how India has been an outperformer, the overweight positioning is there when it comes to investors. But how would you price in the Middle East conflict from here on? How does it play out in your base case?
It's always very difficult. Generally, the story with geopolitical events is there a short-term impact on markets. Now, what you've then got to caveat that statement and look at more recent events, such as Russia's invasion of Ukraine, that caused quite a significant energy shock, particularly in the European community, where the price of gas went up dramatically, which hit the price of electricity. And then you had a fundamental impact which needed to be priced in. I think the issue with crude oil is that it's a very fungible asset, an easily moved asset. It's not like gas, which requires pipes, degasification if you're using LNG. So I think you probably might see a temporary spike in the oil price as the fundamental factor here, even if this is to escalate a bit further. So definitely risk premiums will rise near term. Whether it is a medium-term fundamental impact, I'm not so sure.
Adrian, hi, great to have you on the show. And you make that really interesting point. And I think we started this debate right when the Chinese market did that, recoil spring effect as it completely started pole vaulting, 24% up on Hang Seng in the last 1 month. The question is how much more FPI selling? Because anyway, foreign investors have been largely underweight or neutral in best case on India for a long time. So perhaps we're talking about funds or passively or actively managed funds which already have positions and are booking profit. Are you expecting this to really increase in a more meaningful manner? And if that happens, would you expect that whole wave of domestic liquidity to still support the market? I mean, the Nifty is down only 4% from the peak. What do you see ahead in the coming few months?
So my understanding of the positioning of active managers is they are overweight, which is a good place to be because India has been a significant outperformer. You know, it is about a quarter of the EM benchmark these days. So if you wanted to outperform as an active manager, you needed a big exposure to India. And you wanted to be very underweight China because up until about 30 days ago, or even actually 14 days ago, being underweight China was the smart move to have. So I do believe that active managers are overweight India and they're having to sell down where they're overweight in order to find cash to put into the China market. So India is the wrong side of that flow story. Now, it's always difficult to measure the overall size of these positionings. We do get some data from the ETF markets about the positioning of active funds, but it's relatively limited.
Hi, Adrian. Good afternoon and good to see you in. So you're pretty clear on that. Since fund managers were overweight India, maybe taking some money off the table and deploying some money into the Chinese market. But with regard to the Chinese market pop that we've seen it before, right? In the last couple of years, we have seen them bounce up and then those markets give it away. Do you think this time around the measures that have been announced are good enough to hold the economy in good stead and in turn boost up the stock market as well? Or do you believe that again, it could possibly fizzle away?
So I think we need to phrase it the other way around, that you need to push up the value of financial assets to help the economy. So if your test is, I need to see the economy being better, then don't bother buying China because you'll have missed the rally. So I think the level of policy support this time is very significant. So if we think about the other rallies that we've seen in China, we had a rally in China early in the COVID story because their zero COVID policy did allow them to basically open up the domestic economy. And the Chinese equity markets did extremely well in 2020. You had a sharp rally in late 22, early 23 on the opening up story, but there wasn't any real policy support beyond the opening up. If we go back to a market like the US market, the US economy is opening up in 2021, 2022, and the US government's providing very significant fiscal support. So I think the way to look at it this time is the Chinese policy makers realize that they have a serious structural issue, and this requires dramatic policy action, both in the monetary field as well as the fiscal field. And I think the monetary policy is quite innovative. When we look at what's going on with how they're supporting the housing market, making sure the banks have got a bit more capital to play with, these all look like smart, innovative things. And remember, they're doing it against a backdrop of deflationary pressures, which does give central banks a lot more flexibility. If you're not worried about inflation, if you're worried about deflation, we know how innovative central banks can be. And I go back to that Mario Draghi ECB analogy, which was a very, very significant event for capital markets and resulted in many years of risk assets doing well.
Absolutely, whatever it takes. How can we forget those big lofty words? That was a phrase that became, I think, capital market history, right? Adrian, but just to go back to the point on India, you explained why the shift is happening, active managers selling down a bit of India and maybe moving that money to China. But the second part of my question was how much more? The Indian market hasn't seen a meaningful correction in, I don't know how long, I think 2-3 years since COVID. So what sort of a correction would you expect in India? And would you be advising to buy the dip?
So firstly, I'm not aware of any significant negative delta on the local fundamentals of the Indian economy. I think we've continued to got inflation coming down, economic growth is robust. There's maybe a modest negative story in that the oil price is moving up, but it's moving up from an extremely low level. and that the Indian bull market has been driven, as you've indicated earlier, by local investors, not by foreign investors. So I think if there is a correction in the Indian market because of the events we're talking about, it is a little bit of pressure from foreign selling and local investors concerned about the geopolitical risks rising. So I would view it as being a modest correction. And, you know, there's nothing wrong with a bit of a correction in what has been a very powerful bull market. You know, at best, you're sort of up 20+% year to date. I think it's moderated to around 16 as I look at the sort of international indices. But I think that's fine. Maybe another 5% to go. But I don't see anything in the Indian fundamentals justifying a more dramatic sell-off.
Just a couple of rapid-fire ones, Adrian, if you're up for it. You said a couple of times the stimulus in China seems to be very big, but we've not really heard anything concrete, right? Essentially, it's media reports still, international media. On the monetary side, what got people excited is fiscal. And there, those numbers of 2 to 3 trillion renminbi, I mean, that is still in the realm of sort of news reports, etc.
So what we have so far is a lot of statements from the PBOC, and the PBOC has been criticized for not doing enough considering the deflationary forces that are in place. And so the actions in terms of pushing capital into the financial system, both into brokers, into banks, providing capital for SOEs to buy property and take this excess property supply and turn that into government social housing, where there is a chronic shortage of housing for the lower income groups in China. These are all quite significant statements. So from what I see at the monetary level, and I use the monetary level in terms of what the PBOC is allowing to happen, I think those are very significant. We do expect further fiscal policies. Although China's fiscal position is currently very supportive, it has quite a high fiscal deficit already, but I would expect more from the government there. But this, to me, I go back to the ECB, Mario Draghi analogy. It's what the central bank is doing. And remember, it's again, powerful analogy. The ECB was heavily criticized for being very slow in the GFC. They were putting up interest rates as we were beginning to see the subprime housing crisis build in the United States. They were slow to appreciate the deflationary pressures. They were slow to appreciate the pressure that was on the peripheral bond markets in Spain, in Greece, even to some extent in Italy. And then eventually Mario Draghi came in and he got that they had to do something dramatic. So we have a central bank that was viewed to be very behind the curve, and it's come through with what looked like dramatic measures, certainly relative to what we've been seeing from them in the past.
Adrian, just a quick word on India then, back to India. Are investors concerned about SEBI tightening the F&O regulations? Have you picked up anything on that?
I haven't, but you know, when you're watching some share prices go up 25% in the day in China, sometimes you miss the small print from SEBI.
Okay, all right. We'll leave it there, Adrian. Great conversation. Appreciate you joining in, and it's a good chat. And hope you'll sort of join us over the next couple of days as well as we continue to attract this. I mean, the big move in sort of Chinese equities, why, of course, Hong Kong listed securities for now this week because China is shut, and of course, what's happening here in India. We'll take a very quick commercial break here. We continue, of course, our market chat. Rohit Srivastava of India Charts will be joining in with what you should be doing. Large caps, mid caps, everything. Rohit tracks, a whole host of data sets, both local and global. So that's coming up.
Welcome back. Trying to see if there's any improvement, but unfortunately that's not the case. We're still dealing with almost the lowest point of the day. 25,230 thereabouts is the low, and we're just a couple of points above that. As you can see, it's been a sliding slope all the way down. Look at the India VIX. That's surged in a big way today. I think 13% up last I checked. Yeah, make that 14% right now. So it's been that kind of a session. Rohit Srivastava is joining in from India Charts. Rohit, great to have you on today. You definitely need some perspective because I think traders and investors in India tend to forget what market falls look like, right? We've been in that kind of a market. But you tell us, what sense do you make of this? We're down 4% from the top on the Nifty. It's not much. What do you see ahead?
So it's interesting, and we'll have to break it down into 2-3 different time frames. One is the very short term, because we have seen this fall go on consecutively for like 4 to 5 days now, I think starting from Friday. And that puts us in the short term at a very, very oversold condition. The way it's falling, the RSI indicator, for example, is at almost 16. That's an extreme. We have our own proprietary momentum swing indicator dropping below 20. So that's entering oversold territory. What this all tells us is that we should be overdue for a bounce back from here. Not necessarily today, because it's the weekly expiry and all that puts additional pressure on the market bouncing back immediately. But definitely tomorrow, I would like to see it retrace some of these losses, whether it retraces 38%, 50%, or the classic 61%. That we will, of course, go ahead and see. But the other change which is happening with this breakdown is that it is starting to break the trends on the weekly and monthly degrees, which means the medium term, longer term setups. I'll not say long term yet, but definitely medium term, which means for the month of October, we should stay prepared, not just for more volatility, but let's say for more downside, because volatility and downside come sort of together. In other words, going forward, every bounce we will be looking at skeptically, possibly with the intent that there may be a opportunity to sell. But here's the good side between the broad market and the Nifty is when we are looking at September, the weakness in the broad market was almost telling that the market is not in good health. But here, when we're actually falling over the last couple of days, we are not seeing the broad market fall that much. So it's actually giving you a different sense of safety, that fine, we are falling, but we are not falling so much. So maybe things are not so bad as far as the investment side is concerned. So we are not seeing a breakdown in many charts individually. Some of them are weaker than others, but it's not like across the board. So that is giving us a slight sense that we can allocate to stocks, based on some kind of bottom-up picking or some kind of trend picking. And so that is good news for investors, that you don't really have a major breakdown on the long-term trends, but you'll have to be selective. But on a 1 month basis, I would still expect more downside, for various reasons. Like I said, one is we are breaking several levels today. These are rising trend line from the August bottom. We are breaking the 20-day average. And, we have an extreme positioning also in the futures market, where the client side is extremely short and, the FI side is extremely long. And the third reason why October could be bad is it is seasonally bad before the US election. If you just look at the last 3 election cycles, October month, the market was down. And November, once the election results were announced, you had what is usually called the presidential rally. The next couple of months, it just goes up. And this is a pattern that has repeated since 1992. I've not gone further back and checked. But that gives us a couple of elections which have followed the same pattern. And would this time be the same? So we should be prepared for something similar.
Interesting data points. Thanks, Rohit, for joining in here on CNBC-TV18. I wanted to focus on the larger constituent of the Nifty that actually led us up to that 26,000 mark, the Nifty Bank. In a matter of 3 sessions, it's lost 2,500 points, close to around 5% odd. How is that shaping up? Because that's been the rock, that's managed to start performing, and now it's underperforming yet again. So levels you're tracking on that one.
Yeah, so Bank Nifty is, I think, at a very critical support. I'll put out a number that's around 51,500, let's say. If we do close below 51,500, it'll be breaking the trend line again from the June lows. And that would not be a very, very pretty thing to happen. So we do hope that, if the upward trend towards, say, 55,000 is still intact, that we don't really break 51,500 on a closing basis. So that is going to be the hope. So we've still not done that. And so it leaves us open with some case that, yeah, Bank Nifty may still have something to show us. But what we'll also do on the upside is that as this market does bounce from an oversold state, which I'm talking about, we need to watch the 61% retracement as well, which means can the bounce really make a new high? Can it get past that critical level? And that level is going to be at around 53,370. So if we get past that, then there are odds that we get to 55,000. If not, any failure to get past that level would again open up another selling to the downside.
Got it. So on the mark on the downside, 51,500. On the upside, 53,370. Got both those two numbers down. Rohit, I also wanted to ask you the largest constituent, the other large one on the index has been Reliance Industries. And it's, been absent from any kind of move in the last 6 months. If I'm not mistaken, Reliance is down close to 3-4%, while you have the Nifty that's up 12-13% in the last 6 months odd. What's going on there? Because now it's broken the 20-day MA, even the 50-day MA, and it's testing lower levels. Your take at it on this 2,820 rupee mark?
Yeah, so Reliance has not been the best stock within the entire setup. I do have an important support level coming in at around 2,743. Since we are talking of stocks, let me just highlight, we don't really give advice, so you should not really take anything as a buy or sell recommendation. But the trade setup, like I said, if I look at daily or weekly momentum indicators, both of them are, bearish signals. The monthly one has still not done that. But breaking last month's or previous, I think last 2 months ago's low, which was at around 2,866, is a not very good sign, because it's the first lower high, lower low pattern that we are seeing since the bottom that we made in March of 23. And that tells us that, that we should be open to more downside for Reliance. That's the basic indication from there.
On the Nifty, Rohit, you spoke about downside for the month of October. What would be the key levels?
Yeah, so initially, like I'm thinking right now that we are getting oversold. The immediate support right here is at 24677 or sorry, 2550. Well, we've broken that. Yeah, so around 25229 odd. So we're sort of at the support, I would say right now. And if this breaks, then where do we go? Then it's around 24,700. That would be the next level, maybe 24,400. So we would be open all the way to the 20-week average, which is 24,500. But I don't expect that to happen one way. That's all I'm saying, because if we get oversold, again, we look, just like I mentioned in Bank Nifty, we would look at the 61% retracement of this fall, which comes in closer to around 25,870. And we'll have to get past that if anything new has to happen on the upside. If we don't get past that, we will look at this as a sell-on rise market.
There's a flash at the bottom of the screen as well. Lots of viewers have written in, by the way, asking about HDFC Securities and the fact that they're not able to conduct trades, etc., in a proper, seamless way. So these are comments from HDFC Securities. Important on a day like today. I mean, I think unfortunate, but they're saying we are facing intermittent issues with respect to NSE derivative segment, working with our vendor TCS to resolve the issue. So that is coming through from HDFC Securities. As I said, many of you have written in with asking us to try and contact HDFC Securities and ask them what's going on. So that's essentially what's coming through, and we hope the issue is resolved speedily, because on a day like today, you don't want, to be frozen out in that sense. You want to be able to do what you want to do in terms of trades. Rohit, so that's a very holistic kind of picture as always. So maybe a bit of a bounce in the near term, but you're saying over the next 1 month, maybe even lower levels from where we are now, right? I'm paraphrasing you.
That's right.
Got it. So two things. One, if you can tell us, is the global cycle looking pretty good? Pretty okay still? Or you think that's also going to go into a bit of a funk? And second is, you said you can take individual trades here and there because broader market is not falling like it was in September. So if you have any specific pockets that you're looking at or stocks, go on.
So what has happened on the global space and where you will find comfort is easiest place to find comfort is going to be in the commodities part of the market. Not just for the geopolitical risk, which makes it positive for oil, but we've seen most of the metal prices rebound since the sell-off in the dollar happened on the back of interest rate cuts, right? So that theme doesn't really go away. So we have two things here. One is the presidential cycle, which means a weak October followed by a post-election US rally. So we would still not, till we don't really get a major breakdown of certain weekly levels, which is pretty far away, I think, for the S&P. We'll not be too negative on it. In fact, we'll just expect a routine cyclical correction for October based on the past data. Having said that, the easy trade here, therefore, is if rates are going down, interest rate sensitives and specifically commodities and metals do well. So if you look at it, metals rallied pretty hard last week. They're not really falling much today. Some of the steel stocks are even up. There could be potential upside in particular oil stocks based on how oil does. So if oil prices actually move up, you look at upstream companies and see whether they can really benefit. You can actually see ONGC mildly positive today. But Reliance is doing something different. So I'm asked that question, okay, why not both? So I don't know the answer. The charts don't look so good on one and look a little better on the other. So these are individual places. I think within mid caps, it's very, very varied. It's not sector specific. So you have to pick individual stocks that are probably holding on to maybe their weekly averages. If you watch a 50-week average and you say, fine, this is a stock which is closer to the bottom end of its range, I would be more comfortable buying there. If I find some which is at the top end of the range, which means up above the 2 standard deviation mark, then I would not really be comfortable buying there. And you have to really make those picks individually as far as stocks are concerned. So that helps in cleaning your portfolio as well. Yeah.
So Rohit, I know that you don't like to talk individual stocks, but maybe some clues, not mid caps, but maybe large caps. I mean, till there's clarity, and we were saying that on the Nifty, we are at support levels. So unless there is a very decisive breach of those supports, if this continues to amble along, what are the immediate trades that perhaps someone can look at? Maybe just one or two examples here and there, large cap trades perhaps for the next couple of weeks.
So yeah, I'll mention the simple single sector, and I mentioned it. It is metals. And pretty much across the board. So it's not like I like the aluminium stocks more than the steel stocks. I pretty much think the whole segment does well. And
apart from that, so metals absolutely. I mean, and even on a day like today, these are the only stocks in green. Apart from metals, anything else?
So there is a hope around banking. Nigel was asking me for key supports. I did give one. If that holds, then I would have some hope around banking coming back, because that was a space that has been undervalued. I think a lot of funds have been nibbling into it because valuations were like at -2 standard deviations on the 10-year chart. If I even look at a big stock like HDFC Bank, and it's already rallied from there, but it's still, that doesn't make it overvalued anywhere close. They're all like fag end of the bottom end. Same with a lot of the NBFCs, which are there. Like I had earlier talked about, say, Shriram Finance also, which is in the index, which also had very low valuations. But the whole point is, will they continue to hold out, and not break down in this correction? If they do, and you get a decent level of entry, then I would probably look at financials as well. But yeah, but it's all tricky, because they are not a direct trade. We are betting on that the interest rate cycle triggers a credit cycle and, many other things. But that in the face of valuations, and then if you get a bigger correction in markets, can those stocks really hold up, or do they also continue to go into a deeper correction? So that is where we get caught in that argument. But these are the places that we'll be really looking for.
All right, Rohit, we'll leave it there. Thank you very much for that perspective. Very useful and very pointed and specific with regards to positioning levels and the broader global picture as well. Thank you very much for that view. We'll take a quick commercial break here. We're going to come back in just a bit from now. Markets, no real recovery. I mean, I think 530 points lower, 25,263. Devin Choksis will be with us on the other side. We continue talking markets. We'll give you some global opinion that we got from BlackRock earlier in the day as well. Stay tuned.
A slim recovery is what we're seeing from the low point of the day. Nothing, can't even call it a recovery, but at least some kind of bounce is what we're seeing. You just want to focus on one stock, NBCC. You should pull up the intraday chart out there. It's trading at around 170 rupees. The stock is down 4%. But intraday it went slam dunk, hit 152, and then it bounced. Just take a look at that intraday chart out there. Fair bit of volatility. It suddenly fell close to around 18 rupees and then it bounced back up there. So just keep an eye out on a couple of these counters. Maybe there was a large sell order that suddenly came in there, which explains why this one did that volatile move. Mitesh Thakkar is back with us. Mitesh, it's a down day. You were sounding cautious this morning and you've got it bang on. What's your view at around this 25,250 odd mark?
Actually, it's been stronger than what I expected, Nigel. I think, I was cautious. I was looking at a pullback, but then this fall has been much more stronger than what I thought it would be. One, there was, good support around this 25,400 mark. 25,400, 450 zone, which is where a couple of averages were converging. I think we've just sliced through that. So that makes me slightly worried. And the Bank Nifty fall also, if you look at it, it's about now 1150 odd points. And the structure remains negative. So the Bank Nifty possibly, there's mild pivot around these levels of 51,700, 51,710 zone, and we are just about 50 points away from that. So if that breaks, then it'll be a worrisome thing for me. So I think, the markets, even if they recover now, I think what will be important is that today's gap also becomes a significant hurdle, because from the highest point of the day, which is 25,639, we are roughly about 400 points lower. And no sign of a recovery. So, the texture for me is that one, don't try to do any kind of bottom fishing. I think, avoid till you get some kind of stability and clear signals of an up move. And we have also, pruned down a lot of our long exposure. It wasn't much any which is because for the last 2-3 days we have started declining, but not venturing into this market on the long side and seeing, whether it goes, because not the best time to short because we've already fallen in the last 4 days, but avoid longs and see if the bounce backs are slightly on the weaker side, and then maybe we'll trade more on the short side.
Okay, got it. By the way, some alerts coming in. Our colleague Harmaz is just pointing this out. Put up some of the stocks like HDFC Bank, ICICI Bank. For HDFC Bank, he's pointing out the levels that if the stock falls below 1643, then it will be giving up all of the gains that it saw from the 11th of September. So 1676, we're still some way off that mark. It's only in the recent past, in the last 2-3 weeks, that bank stocks started their uptrend. And let's see if that will remain intact or whether it gets truncated. Mitesh, great to have you with us this afternoon. So tell us, individual stocks, it's all over the place, but individual trades, what would you look at for the next 1 hour?
So on the stock side, since I'm not venturing long, the metal pack is the only area where we have some longs, and that's the saving grace. But otherwise, mostly, I think, we are looking at short ideas. Right now, I have a sell on HDFC AMC with a stop at 42.55. Look for targets of around 41.30, 41.40, that zone on the downside. And that apart, I think HUL is also slightly turning negative. So a sell on HUL will take a tight stop here, not a very big stop of about 29.21, and a target of 28.30 can be looked at.
Okay, all right, got it, Mitesh. Thanks very much. We'll come back to you in a bit and get some more trading ideas going. We have Devin Choksi of DR Choksi FinServ joining us on this leg of the show. Devin, good to have you on. So it's after a long time that we are getting a day where there's a lot of momentum on the way down. Otherwise, this has been a bull market through and through. Bears rarely get their day. But now that we're seeing a lot of these, issues and concerns play out, what is your advice? Would you immediately go in and start sort of adding stocks to your shopping bag? Or would you wait a while and let the market settle?
Yeah, good afternoon, Surbi. Well, I think that's always a difficult question to answer, because I think in a falling market, more than the fundamental reasons, I think there is a technical aspect to the market, I think, which leads to this particular fall. And the kind of collateral damage, I think, which it may extend to the good quality stocks, I think is something which is unpredictable. So what we keep it simple, I think in this particular scenario, when I think we get some of the good quality fundamental stocks at a given valuations, I think it's a time to keep them adding into the portfolio. Because I think most of the negatives, I think, which we are talking about is more of a possibility and a speculation, particularly on the global escalation side, on the war front and everything. In my viewpoint, I think rest of the conditions in India remains, I think, pretty stable as far as corporates are concerned, earnings are concerned. There might be challenges, of course, I think, on the cost front because of the logistic getting haywire. But the fact remains that I think overall the environment looks, I think, stable as far as I think our corporate earning outlook is concerned. So we would consider buying at an appropriate level individual stocks more than I think looking at the market in general.
No, absolutely, and hopefully we'll get some of your top buys at the in this kind of a market as we go along. But first question on the OMCs. There are sharp cuts coming in on stocks like HPCL. Look at HPCL is down 7% right now. BPCL is down 5.5%, and IOC also losing about 4.5%. Devin, the market is reacting very sharply. These stocks obviously had a good run up as well. Now, the whole narrative has changed, right? Till Monday, we were talking about how on the marketing side, they're very comfortable. They're making a lot of windfall gains. And now there's so much of uncertainty with the rise in crude oil prices. OMCs, do you like them, dislike them? Would you buy?
Yeah, I think more or less the GRM margins have basically, I think, started bottoming out. And even except, I think, last 2 days of, I think, spike that we are seeing in the crude oil, I guess, I think, by and large, the GRMs are bottoming out. And that's positive, I think, for most of the refining companies per se. Given that situation, I think one should argue for going ahead with buying on the list. However, I think the major challenge has now once again popped up about the logistic management. On one side, I think your import of crude oil is taking place. On the other side, I think the tankers availability would be suspected, given the kind of tension that we are having in this part of the world. So to a greater extent, I think that is a cause for worry at this point of time, and not anything else. In my viewpoint, I think other views are not changing. We remain selectively confident about the entire space. But more importantly, I think the comfort level remains higher with Reliance vis-a-vis, I think, the other oil marketing companies or the exploration companies at the public sector levels.
Okay.
All right. Yeah. Devin, just coming to you, we want to play out the soundbite that we got as well. This is BlackRock Investment Institute's Ben Powell. We spoke with him in the morning. This is again about flows more than anything else. This particular soundbite will play out more for you. India, China. Listen in.
The combination of demographic plus productivity gains, digital inclusion, infrastructure, and so forth. I think the big picture in India continues to look very, very favorable. I actually think the short-term issue is nothing really to do with India. It actually could be the gravitational pull of China. So China, as we're all aware, India has become, recently, a few weeks ago, became the biggest constituent in MSCI emerging markets, taking the crown from China. And that's great, right? We've all enjoyed that. But I do think if China is going to follow through on its stimulus promises, which we may see as soon as next week, it's quite likely that some of the money that global investors have put to work outside of China, be that in other emerging markets or other parts of Asia, probably gets pulled back into China. So I think there might be a little bit of a headwind, really nothing to do with India, but to do with global capital flows moving back into the world's second largest economy.
Okay, that's an interesting opinion coming there. By the way, one of the big, pockets which are, under pressure today are Dabur and many of the other companies where you have this beverage portfolio. So something like Varun Beverages is down 4%, Tata Consumer Products is down 3.7%. So these are the stocks impacted by Dabur's Q2 commentary. Devin, comment on Dabur and what they had to say, and is there a broader read-through for the FMCG sector, the kind of impact we would see on account of floods to demand, etc.?
Generalization won't help actually at this point of time. In selective pockets, I think there could be some situations where I think some disruption may take place because of the supply chain logistics. But beyond that level, I think that overall demand scenario remains, I think, pretty comfortable for home care products, for personal care products in the FMCG, or even the food category of products within the FMCG basket. So where Dabur is operating, I believe that I think most of the category of products, I think, are going to see the steady demand continuing. At the same time, I think in these festive months, you are likely to see the surge in the spending. So certainly, I think that is good news for many of the FMCG companies. And fortunately, the favorable pricing scenario on the input side is definitely helping protect margins also. So selectively, we remain confident about the business environment. Of course, most of the things are in price. In the last few weeks, I think the FMCG companies have had a good run. So from that perspective, most of the positive news are already in price, as I would like to add it.
All right, Devin, I wanted your view. You know, sometimes these weak markets gives you an entry opportunity, and one of those outperformers has been Mahindra and Mahindra. They're guiding for better times in the second half of the year with regard to tractor sales. And you know, in the first 60 minutes itself of their openings of bookings for rocks, that's the 5-door, you know, they had got bookings of around 1.76 lakh. Wow, within 60 minutes. What's your view on the stock? Seems, you know, most of their launches are being met with a very good response.
Yes, absolutely, Nigel. I think if you look at last 2 years of launches that they have done and the kind of booking that they have created, probably I think they have been sustaining this particular move on every successive launches that they do. It's a good comeback, I think, as far as I think their portfolio of passenger vehicle products are concerned. One would tend to remain bullish about M&M per se, given the kind of visibility that you get. And comparatively, they face less amount of pressure on discounting side of their vehicles. At the same time, I think the tractor business, which is up till now, I think not contributing enough, is expected to contribute better because of the good monsoon in almost all districts, I think, where the rains have been, I think, on a positive side. So from that point of view, I think we are likely to see a better demand scenario emerging for the tractor and the farm business as well. So both the portfolios likely to show relatively better performance going forward.
Okay, all right, Devin, thank you so much for joining in, giving us perspective on the market. Appreciate you making the time, and we look forward to the next conversation soon. We'll take a break. On the other side, we have with us Varun Goyal of Mirae Asset Investment Managers to get some more views on how you navigate this fall and what should portfolio positioning look like now.
Okay, markets are down, and we've been sort of reporting on the 500 plus point, make it 550 now, point cut that we have. And some of the other market indicators are at the bottom of the screen, Dow futures and a few others as well. Let's welcome in Varun Goyal, who's with us of Mirae Asset Investment Managers. Varun, good to have you on the program. Prashant here. First, quick comment on what your sort of perception. What are you hearing? This kind of selling. What's it on the back of, in your opinion? On the domestic inflow side, again, it's too early. But so far, if you have any sense whether the numbers remain as strong as ever, monthly inflows are to the tune of some $4 billion over the last many months. So this month, what's it looking like? Actually, over the last couple of days, what's it looking like if you have a sense? But start with the drivers for what's leading the market lower.
Yeah, good afternoon, Prashant. Thank you so much for having me. I think as far as the monthly numbers are concerned, we have to wait for, I think, 7th of the month. That's when the industry data comes out. I would not have any latest data that I would be able to comment on. But from broadly what we have been seeing, the domestic inflows seem to be on track. I don't think there is any major deviation, but let's, of course, wait for the data when it comes on the 7th of the month. Broadly, I think if you look at the valuations, we are trading at around 20 times FY26 earnings, which is around 8 to 10% more expensive than the historical average. So I think a 5-10% kind of a correction, if it happens for geopolitical reasons or otherwise, could help take away some froth from the market and make the medium to long-term outlook more attractive. So as such, we would not be too concerned about what has happened in the last few days, and hopefully the medium to long-term India growth story and the earnings outlook remains largely the same.
So is that the view that from the top, obviously no one can forecast, but it's possible we get to between 5 to 10% kind of a pullback? We perhaps get that?
So we don't know, of course, Prashant, we need to monitor the geopolitical developments very closely. And of course, just to add to that, if you look at the domestic data points, they have been little on the soft side. The high frequency data in terms of GDP growth, the PMI for manufacturing services, auto sales data. And of course, today being the first day of Navratri, this is the beginning of the festive season. We do hope that the domestic consumption really picks up during the festive season. Also, if you look at the capex data a little bit, on roads, railways, defense, in the first 6 months of this fiscal, it has been a little subdued. Of course, there were elections and all, and one hopes that in the next 6 months, it can catch up to meet the full year budget target. So these are some of the data points that we should also track from a domestic perspective. I think as far as earnings are concerned, FY20 to 24, we had almost 18 to 20% compounding in Nifty. Going forward, at least for FY25-26, our expectation will be a little more muted. Maybe 10 to 13, 14% kind of earnings CAGR from this point onwards looks more likely, and that is how we should be looking at the market.
Varun, hi, afternoon. You said that how some of the high-frequency domestic economic indicators are a bit subdued and tepid. So how are you positioning yourself in your portfolio? Are you positioning that the domestic economy continues to remain a bit subdued, or are you penciling in a pickup in the second half of the trading session? Because you have been bullish on some sectors like travel, tourism, hotels, etc. So what's the expectation on the domestic front for the next 6 months?
Yeah, good afternoon, Rima. So I think, I was just mentioning that some of the recent data points have been a little subdued. One definitely hopes that the festive season is good and the growth really comes back. I think for the year as a whole, RBI continue to expect a 7% kind of a real GDP growth. I think if you look at the budget estimates, we are looking at 10 to 11% nominal GDP growth. So broadly, we are there in line. Of course, if the incoming data points suggest otherwise, we may need to revise it differently. So our sense is broadly we are at that 10 to 12% kind of a nominal GDP growth, and earnings growth as far as Nifty companies are concerned will broadly be around the same lines. Last year, of course, we had the big benefit of commodity prices coming down, and therefore margins expanded. So while sales growth were in single digit, the EBITDA and PAT numbers are much higher. I think this year we may not have that kind of benefit on the commodity side, and therefore the top line and the bottom line growth may be in line. So that is the point that I was trying to to talk about. I think broadly, as far as India's domestic growth story is concerned, we remain pretty much on track. Both the investment side and the consumption side largely doing okay. There might be 1 or 2 quarters of seasonality-driven slowdowns and all, and one hopes it kind of picks up along the way.
Okay, Varun, hi, good to have you on. So the commodity side of the market is getting more and more interesting, right? There's a huge focus on metals, courtesy what's going on in China. Then there's a lot of volatility on the oil and gas side. What has your approach been, and are you willing to look at some changes if you believe that the China rally is durable and therefore perhaps the metals move has more steam?
Yeah, I think almost half of the commodity demand for the world, take all industrial metals, take steel, comes from China, and China remains a very big driver of commodity prices. One needs to watch out whether the current stimulus measures announced and discussed and debated actually come through and they help in stabilizing the economy. I think the jury is still out. We'll have to wait and watch. While the market's definitely excited, one needs to really wait and watch out to see if the Chinese growth can really stabilize. And because if Chinese growth comes back, the metal prices can definitely see an uptrend. But I would still want to see more concrete evidence of that stimulus having an impact on the ground. At this point of time, we're more like an equal weight stance on the middle space as far as I'm concerned.
All right. Hi, Varun. Good afternoon. Good to hear your thoughts. What about the IT space? In the next week or so, we'll be getting those numbers that start trickling in. And, most on the street believe that maybe the worst is in the price. From the second half of the year, you could see some increase in spend. And that's what will give a bit of a runaway for growth for FY26 onwards. How do you see things panning out and your approach to the sector?
Yeah, definitely positive on the IT space. I think clearly there are signs of turnaround as far as the US BFSI demand is concerned. I think the mortgage space, wealth management space, all are seeing green shoots. I think the interest rate cut which has happened in US is also very welcome. Over the next 6 to 12 months, we expect the North American banking, which contributes almost 1/3 of the top line of the Indian IT sector, to see better prospects. A lot of deals which were kind of under discussion, there were pressure on pricing. I think some of those concerns can get addressed. So incrementally, we would be positive on the IT space. I think one really has to pick and choose those names which have a significant exposure to the BFSI as a vertical, because that will be the first one to recover from the slowdown that we've been seeing in the last 1.5 years.
Any changes, Varun, to your portfolio, the way you've aligned it in the last 2 or 3 months, given the different winds that are blowing geopolitically on the domestic front? How is your portfolio positioned now, and how has it changed?
So broadly, we remain overweight on pharma, IT, private sector banks. I think these spaces continue to do quite well. We believe residential real estate, we are still in the midst of a big uptrend, and we are only in the mid-cycle. So we remain positive on developers as well as the building material companies. I think power capex continues to be a very, very strong theme, both conventional and renewable. And we continue to see major investment being undertaken by both public and private sector. So continue to be constructive on that side. So these are some of the themes I know that one would prefer. The portfolio is largely stable with some minor changes.
Okay. Varun, just a quick, just to sort of tie in the earnings bit, overall, right, across your analysts that you've spoken with, Q1 was, a lot of companies said, well, there was that heat wave and there was elections, etc., which marred numbers. But Q2 also, across sectors, generally, sense is that it's going to be not such a great quarter. Is that the view you're getting across the board?
Yeah, our sense is the second half is really, post the festive demand comes in, and we see recovery in domestic consumption, and some of the export-related demand also comes back. So I would expect the first half of this year to be a little weak, and the second half is really when we expect the earnings growth, also driven by some of the government capex, which has been a little slow to start to come back.
Okay, all right, got that. Varun, on the capex side, because even before we got into this volatility and this whole global fall, in any case, the market was undergoing a bit of a texture change, right? There was some profit taking in capex plays and PSUs, and we saw that money start rotating back into areas like banks, financials. So have you been tweaking portfolios accordingly as well? And what is your own stance on financials, especially capital market plays? Look at all the policy moves that have finally happened, and stocks are reacting in a very interesting way.
Yeah. So I think if you look at the capital market story, I think there was a very interesting study done by one of the brokers there that from 85 to 2004, if you look at the US, that is the time when inflation got tamed in US and post the Volcker really coming in, and then a very consistent set of low inflation, decent economic growth. For 20 years, the financialization of the US savings really played out, and the sector really multiplied 20x from where it started. I think for India, we have seen almost a 6x. We have come in the last 10 years, and I think we have a long way to go. So continue to be very constructive on the financial savings as a theme, as long as we have an inflation targeting framework, as long as RBI remains determined to keep inflation within that 4% plus minus 2% kind of a range. I think we would have a fairly long period of financialization of savings, where more and more money can come into financial instruments, on equity, on debt, on various other instruments. And therefore, that is a theme that like in US, played out for almost 2 decades before peaking out sometime in 2003, 2004. I think we are still midway, and we have a long way to go.
Right. Varun, Mirai has a China fund as well, right? It's a FOF?
So we do, but Prashant, I would not be able to talk on that. I'll be happy to connect you to the right person for that.
All right. No, fair enough. I was just checking whether that is seeing any.
No, we do have.
On that. Yeah,
yes.
Yeah, absolutely. We'll leave it there, Varun. Thank you very much for your time. Appreciate it, and good speaking with you as always here on CNBC. We'll take a break. We're back, and we do a quick check on what's happening with dealing rooms. D Street Chatter with Nimesh coming up. We'll get you all the going-ons in dealing rooms and all the sort of gossip and buzz. Of course, after that, we'll also welcome in our technical analyst for some trading ideas. Stay tuned.
Welcome back. Market still sitting with a cut of around 550 points, and the problem pocket is the Nifty Bank, which has lost close to around 1,000 points. But the person who can give us an insight into what he's picking up with regard to D-Street chatter, Nimesh is with us. Nimesh, it's a truncated week. The bulls would have not wanted to come back, and I think the stop loss today is 330. But tell us, what are you picking up in D-Street chatter?
Well, it's largely a global risk off, which is putting India also under pressure. But today's and it's largely backed by large FI selling as well. We saw on Monday, we saw on Tuesday. Again, there is a very large sell-off. Is what I understand. Imagine the buy-sell ratio at FI desk is nearly 1:3. When I mean one buy and there are 3 sells. So that's the kind of intensity which is there within the FI selling. And even that is largely in the large cap names. Look at the fall in the large cap names like Reliance, HDFC Bank, ICICI Bank, Kotak Bank. That's where the pain point seems to be. There is passive selling happening. And maybe one reason to explain is that maybe the money is moving out of India to China. So that's something which potentially is playing out, and we will further see that once China reopens on Monday. And we spoke about it, right? That's the potential risk for India, at least in the near term. So that's playing out. I think barring metal names, there is selling across the board today. And that explains, Nifty, Bank Nifty, mid cap, small cap, all the indices are down nearly 2%.
Yeah.
Having said that, a couple of things to watch out for. We are very close to the crucial technical level of 25,200 on the Nifty on the downside. So we are pretty much around that. And also, if you look at intraday, the PCR followed was almost at 0.7. We're now at 0.75 odd. Normally, we've seen markets bottom out around 0.7 on the PCR. So that needs to be taken into account.
Yes.
Closer to the technical level, so watch out for that as well. But there is clearly selling pressure from larger FIs in the large cap names, and that's the reason why you're seeing intense selling and Nifty largely under pressure, largely led by the likes of Reliance, HDFC Banks, and Kotak Banks of the world.
Well, point well taken, Nimesh. What about individual stocks? What are you picking up?
Nigel, while markets have been down another 500 points today, the breadth doesn't seem to be that bad.
Yeah.
And there are a lot of mid-cap and small-cap which are buzzing in trade. So the first name on my list today is R Systems. Not buzzing in trade, but it's been consolidating in a very narrow range. But now I understand there's going to be a very large block in R Systems very soon. I'd spoken about it a couple of weeks back as well. There is one large NRI investor who owns close to 29%, and he can potentially sell around 10%. So that's the buzz that I've picked up in our systems. The second name is Strides Pharma. That's been buzzing in trade almost at 52-week high. The volumes are on the higher side. It's been buzzing largely because one of the subsidiaries of Strides Pharma has recently raised close to $100 million from very large influential investors at a very high valuation. So that explains a big up move in Strides Pharma of late. The third name is EPAC, a recent listing. But again, that's been buzzing off late. The volumes on the higher side, few HN investors seems to be active buyer as well. I believe one PE fund was to sell a partial stake. That's largely been done with, and there is a very strong buzz that maybe over the next couple of months the company is likely to back few large orders as well. So that's a trigger on EPAC. And the last name is Paytm. This is going to be interesting. We saw a big move on Paytm yesterday as well. The volumes have actually picked up off late. A leading domestic mutual fund has been an aggressive buyer in the last few days. And also there is a very strong indication that maybe a corporate development is lined up in Paytm very soon.
Thank you very much for that. So EPAC, Paytm, some stocks which Nimesh is watching out for. For the markets, the sell-off took place from 10 to 2 p.m., 10 a.m. to 2 p.m. But after that, we've pretty much been stable with about a 550 point cut. No incremental selling, but there is no recovery. Mitesh is now with us for a few BTST calls. Mitesh.
So I think, one difficult to guess whether it will be a gap up after a decline or gap down, depending upon how the international markets behave. But we'll go with some stocks, when the patterns are slightly biased on the negative side, given the fact that, we're trading below support levels on the Nifty. So M&M Finance is something, which is on my list. I'll pick a STBT with a stop at 324.5 for targets of 316, 317, maybe even lower. But yeah, let's see. And the other one is a BTST, which I would recommend a BTST on Lalpath Labs with a stop at about 395 and a target of around 34.50.
Okay, thank you very much for that, Mitesh. Ambrish Balika is also with us on the show. Ambrish, afternoon. What have you made of the kind of session we've had today? And what are you doing? Have you used this opportunity to buy some of the stocks that you like? Or are you a bit cautious now from these levels?
No, I've been cautious for a while. And this fall, we don't know whether this is the beginning of a fresh fall or whether it would be like, similar to the earlier falls where we fell about 3-4% and then at lower levels the buying came in. But whatever said and done, I think overall for the index, I think the valuations were getting a bit too expensive, and liquidity was the only driver, and it required an external factor to break that rally, and that's been Iran-Israel war. But then at the same time, there were other negative news which was getting ignored by the markets, which was the PMI manufacturing, which has started falling. We had the GST numbers where the growth wasn't as good as what we've seen in the past. And at the same time, I mean, if you see the last at least 3 to 4 weeks, although the index was touching new highs, the portfolios were hurting because most of the stocks in the portfolios of retail investors, basically, I mean, who had bought defense, railways, and all the other stocks which were not performing, that has started hurting. But still, liquidity was flowing in. But I don't know whether, I mean, if this issue carries on for a while longer, in the sense, if the war escalates, then the sort of sentiment and liquidity which you're talking of can disappear overnight. So after that, the fall can be much deeper. But I think at this point of time, we just need to wait and watch. And as far as buying is concerned, yes, I mean, surely with the fall of about 1,000 points from the top, you should, in fact, if you're sitting on cash, yes, it makes sense in buying to a certain extent. For example, I've been telling you that we've been in cash of about 40 to 50%. And in that sort of a scenario, I would possibly deploy 2 or 3%. I'll not really go out and buy 10% today.
So one of the stocks that you're recommending is Dhampur Sugar, which looks attractive to you.
Yeah. I mean, typically on a day like this, I wouldn't have recommended a small cap stock, but then this seems to be a compelling one. That's the reason I'm recommending on a day like this. It's one of the leading sugar mills in India, and in addition to sugar, they produce power through cogeneration, where they have a capacity of 126 megawatts, ethanol 350 kiloliters per day, ethyl acetate, as well as potable spirits. In fact, they've achieved about 20,000 cases per day last quarter. And in fact, last year, the ethanol capacity was increased. And in addition to molasses, they've been able to use damaged grains as well as maize, which is a very positive thing. Last quarter, the crushing was much lower. And that's one of the reasons for the performance to be weak, like the earnings were weak last quarter. And because of which we have seen the stock underperforming. And this is one of the reasons why it came as a contra buy for me. Because going ahead, clearly, sugar and ethanol scenario seems extremely good. Prices have moved up, so margins for Dhampur should start moving up from here. And all the capex has been completed. So there is no further capex, at least for a year or two, which has been confirmed by the management. And the benefits of the capex already done, I think, should start accruing now. So expected EPS for FY26 is about 33. And with that, my target price is about 330.
Okay. By the way, looking at some very interesting moves in the broader market, while it's a down day, let's pull out some stocks that are managing to buck the trend. Some of those names would include ITT, cementation, obviously, because there's so much of buzz around the company on whether there's a deal coming up with Adani or perhaps a different suitor. So that's one.
They also won an order worth more than 1,900 crore rupees. So that was announced early in the morning, and that's when the stock went up, locked in an upper circuit.
Yeah, so that's been an early mover. There is KRN Heat, which is a new listing, which has been definitely a very hot listing, 117% up on KRN even now. And by the way, Amber Enterprises, as we speak, is surging 8%. There's been some buzz and chatter that is there some rub-off effect because of the kind of valuations in the interest that KRN has generated in the market. They're into the business of heat exchanges and management of heating systems and cooling systems, actually, for a lot of industrial applications. Amber obviously has a very big room air conditioner market. So I'm not sure if there is any immediate parallel, but something that the market wants to believe or is sniffing for sure. 7.5% up on Amber. Just very, very quickly, Ambrish, any thoughts here on Amber or today's listing?
I see. In fact, Amber, we've been positive for a while because if you see, they have one of the largest market shares in room ACs, and where we have seen the demand continuing to increase because it is no longer a luxury; it's a necessity, especially in Tier 1 and Tier 2. So clearly, I think Amber will still see further up move. And the other stock which we discussed about was ITD cementation. Frankly, this was my pick for the day today. But then I had to drop it after the stock moved up 100 rupees, and that's why that's the other reason why I came up with Dhampur. My original pick for the day was ITD cementation. Clearly, the way the order flows are happening, 18,500 crores of order book, and in fact for the current year, the expectation for the next 12 months is another 10,000 crores of order flow. In fact, here I have a price target of about 712, but then it didn't make sense. I mean, giving the call at 6:45 and saying 712, so that's one of the reasons I dropped it.
Okay, Amrish, to stay on, we need to slip into a very short break. We'll come back in about 9 minutes left for markets to close. It's been a painful session. The Nifty is around 25,250.
It's been a disappointing trading session. We're going to be ending closer to the low point of the day, just around 5 minutes to go before the final bell. And as we said earlier, it appears there was only one stop loss today. That is 3:30 p.m. and we're almost there. Well, we're still in conversation with Amrish Balega. Amrish, good afternoon. Wanted your view on a couple of these names, BSE as well as Angel One. See, there was this probability that we're going to be getting some notification coming in from SEBI, and it's more or less in line with what the proposal was. Today, these stocks opened up mildly lower and they just took off. You know, BSE, Angel One, both of them are trading well in the green. Your view on this pack?
No, I would be cautious at this point of time because most of the volumes were coming in from the F&O side. And with like F&O being out of reach for most of the retail going ahead from November onwards, clearly I think the volume will suffer. Along with that, the brokerage will suffer. And don't expect these traders, who are living day to day, to come back as investors. I think that's one talk which is going on, that most of these people will become investors. I don't think that's possible, because that's not the mindset. So I would be cautious at this point of time. In fact, something like a BSE at these levels, I would possibly go ahead and sell.
Okay, that's BSE indeed one of the big newsmakers of the day. By the way, Petronet LNG is up 5.5%, a distant cry from a lot of the other oil and gas names, the OMC stocks, for instance, that have fallen quite a bit. So Petronet is managing to hold ground. And as we are finally closing down, if we talk about some of the key losers, where the profit taking has come in, DLF, PFC, these are some of the weaker names. Amrish, finally a word on Dabur, because Dabur has kind of, taken the market by surprise by talking about the possibility of revenues falling when we're talking about a rural revival. What do you make of it?
I think, it's fallen because of the management commentary which had come about the weak possible sales. But then I would utilize this as an opportunity to buy, because in fact, we bought to some extent in the morning, at the same levels, about 575, 580. I'll not be surprised if it falls more, but then I would possibly utilize that to buy and add more to Dabur. Again, it's not a one-quarter story. We are looking at it at a much longer term. The next 12 to 18 months, if you have a view, I think it's a great time to buy Dabur.
Okay, Amrish, thank you very much for joining in. We're wrapping up Thursday's trading session, and we're ending with a cut of about 2%. Global markets were in a tizzy because of rising Middle East conflict, so that weighed on sentiment. Brent crude prices have crossed $75 per barrel. Added to that was the SEBI curbing the F&O regulation, making expiry just once a week for NSE and BSE, so that hurt sentiment on the side. So lots of factors at play, and by the end of it, the Nifty and the sensex down 2%. The Nifty ending around 25,250, more than 500 points lower. The sensex down 1,700 points. Advanced decline ratio stands at 1:4, more than 2,000 stocks declining, ending in the red, with the mid-cap index down over 2%. All the sectors ending in the red. I think metals tried to put up a bit of a fight, but by the end of it, I think metal index too seeing a little bit of a downtake. But the sectors which took it on the chin today were realty, so that's down 4.5%. Banks continued to get hit. The Nifty Bank is down for the fourth day in a row. Autos, oil and gas, PSCs also under pressure.
Absolutely. So those are some of the key trends that played out. Just to continue, some of the names that we were highlighting where the profit taking was very, very visible. Look at names like Cummins, 5% down. Dabur, we've discussed. DLF has lost almost 6% as the market's closing down. A couple of the wealth managers, 361, Novama Wealth. These are stocks on the lower side. KFin, down about 6%. So a lot of the market infrastructure plays, capital market related plays, and the wealth managers, they've been under pressure. JM Financial, for instance, is down 6%. But against this backdrop, look at Angel One. Angel One saw a bit of perhaps a relief move now that the news is formally out. 5% up move on Angel One, and Amber was the other highlight, up about 6%. And ITD cementation, by the way, final count continues to be that 20% circuit on the stock. So the bell has gone, the day has ended with a 530-point drop on the Nifty, and the mid-cap index losing a little more than that, down about 2.3% on the mid-cap index. Okay, that's a wrap on this edition of Closing Bell. Thank you very much for watching. But don't go anywhere. A special edition of Markets Forward coming up on the other side. The market sell-off in just a moment.